Good evening, everyone, and welcome to the first of 3 Farmers Weekly webinars on tax in partnership with accountancy firm Baldwins. I'm Andrew Meredith, Deputy Business Editor at Farmers Weekly, and I'll be doing the housekeeping tonight. I'm delighted to be joined on the line by 3 speakers who are much more knowledgeable than myself on navigating tax issues, and over the next hour, we'll take you through some of the latest advice and information. First up will be Liz Jones, a Chartered Tax Advisor and Partner with Baldwins, who will be presenting on the most important aspects of tax planning for your business. Then we will hear from Clive Beer, who is Head of Professional Services for Savills, and will be speaking on how to make a success of succession and where tax plays a role in these deliberations. For the final 10 minutes or so, we will then throw open the floor to yourselves for any follow-up questions you have for our speakers and for Ian Smale, Chartered Certified Accountant, also with Baldwins. If you are new to the webinar process, questions can be submitted by typing in your query in the auditorium box that you will find on your screen, and I will then direct those questions to our speakers. The whole webinar is expected to last for 1 hour, and we will be able to email you copies of the slides afterwards and answers to any questions that are not selected. So, without further ado, I will hand over to Liz for her presentation. Take it away, Liz.
Good evening, and thank you for joining us. As Andrew said, my name's Liz Jones. I'm with Baldwins Accountants, and we're just going to run through some of the main points tonight with succession planning. So first of all, what is succession planning? Well, fundamentally, it's a consideration of some of the options you have available when you're looking at your farms or estates and how to leave that to the next generation or what to do with those assets. So some of the points that we need to consider. Firstly, we've got the ability and the attributes and skills of the generations. So looking at the parents, looking at the children, who can bring what to the table, who can bring extra skills to the business to move that forward in the forthcoming years. Secondly, we need to look at the income for the retiring partners. So the parents perhaps that are leaving the business, do they still need to gain some income from the farm, or have they got streams from elsewhere, for example, rental properties, pensions, etc.? Then we need to have a look at the strategies for bringing in the children, various different options available, and no one size fits all. Then we need to have a look at the property. So what property does the business have, and how can we look at passing that down to the next generation if that's what we want to do. We also need to consider any non-farming children that may be needed to be taken care of. Those that aren't going to take over the business, those that aren't going to work on the farm, do you want to provide for those in your wills and leave something to them? And then finally, we'll touch briefly on inheritance tax and will planning. So first of all, we'll look at the next generation. One of the first questions to ask is, do they want it? Don't actually assume that they want to come into the business. You may be thinking that they want to come in as a partner, that they want to join you in the business, but that may not necessarily be the case. So perhaps have that conversation with them. Secondly, have they actually got the ability or the drive or the ambition or the skills? They may want to come into the business as a partner or as an employee, but there may be some training required. They may need to work with you to actually bring themselves up to the required standard. Next, you need to ask yourself, can you actually work with them? Not all parents and children can work well together, and that may be something that you need to consider. What age do you want to bring them into the business? Some children will be ready for partnership at a very young age, others perhaps not. And do you need to consider whether or not there's any extra training needed? This may be external training, or it may be something that you can provide. You can give them guidance to work with you in the business. Moving on then to the income for the retiring partners. Have a word with your children, speak to them. The children may have assumptions about what your needs are. What you think you need for income and what they think may be very different. You need to make sure that you are actually working together and have the same ideas. Set the situation up correctly from the start. Speak to them. Don't lead them on. Make it clear to them what you are or are not expecting from the business. Be clear, and if you have strong-minded children, hold the line with them. Again, they may suggest to you what you might want to take from the business. that may not be in line with what you're thinking. Have consideration for what you actually need to live on. For example, if you're thinking 24,000 to provide just a normal lifestyle, a car, running the house, food, holiday, etc., if all you're relying on is money invested, you'll need £1 million invested at 3% with a 20% tax deduction to provide £24,000 of net income. If you haven't got that sort of funds available, which not many have, where are you going to get that income from? Again, is it going to come from the farming business, or do you have other sources of income, pensions, etc.? So look at the farm, look at non-farm incomes, and work out how much you need and where that income is going to be derived from. If you do have excess income, whether that's derived from the farm or from other sources, you can always consider gifting that back to the business. It doesn't have to be permanent, it could be a loan or it could be a gift to the children if they want to use that within the business and invest it for the future. So once we've considered the income for the retiring partners, we can look then at the strategies on introducing the children. Various options available, and one of the perhaps standard or normal methods is to look at bringing the children in as employees initially. Then you could bring them in perhaps as partners on a trading only basis, so that's without the property, and then you can bring them into the business perhaps with a share of the property. So looking at the employee option first, there are, as with everything, pros and cons. So if you bring them in as an employee, one of the disadvantages is the additional national insurance costs. The children will have a higher rate of national insurance than if they were self-employed, 12% versus 9%, and the business will also have to pay the employer's national insurance at 13.8%, so it does bring with it an extra cost. You'll also have to bear in mind minimum wage requirements and contracts of employment. On the other hand, if you find out that you can't actually work with your children and disputes arise, they can actually cease the employment relatively easily, whereas if you brought them into the business as a partner, it's not quite so straightforward. Okay, so once we've looked at bringing them in as employees, we can then perhaps consider bringing them in at a later date on the trading assets only. So this, for example, would be the plant and equipment, the trading stock, but not actually a share of the property. Why would you do that without bringing them in on the share of the property first? Well, perhaps to protect your children from themselves, not risk letting their partners run off with family assets. Perhaps they have relationship issues that you may or may not be aware of, and this again reinforces the importance of speaking to your children. Some of the most common options when you're looking at bringing the children in on the trading assets only, you could look at a farm business tenancy where perhaps you retain ownership of the property and they run the business in their own name under a tenancy. Or you could look at a partnership whereby you all work in partnership together, or a combination of the two. So looking then at the farm business tenancy, what's the benefit of that? Well, if you don't want to remain in business with the children, it does actually give some control and independence to the children, allows them to run their own business, but again, without actually giving them a share of the property at this stage. If you've got strong-minded children that again perhaps you can't work with, this may be the better option, certainly in the first instance. Moving on from that, if you want to bring them into the business as a partner on a trading assets only basis, there are other factors to consider, and some of the benefits could be flexibility. You've got the option of giving prior share of profits to the parents or to the children, perhaps, maybe to cover the rent of the property, maybe to cover interest on the capital account they've got. If the parents then want to retire from the business later on, you've got the option of paying out that capital over a number of years, which may help with the cash flow of the business. It prevents you having to find large sums of money all in one go. Where you do have more partners in the business, so perhaps both parents, one or two children, perhaps their wives, you've got the option of using the basic rate tax bands. This prevents one partner paying tax at the higher rate of tax, where another may be wasting the basic rate tax band. So it allows you to move the profits more easily between the partners, making sure that you're making use of those tax rates. It also brings the children into the decision-making process, makes them feel a part of the business, makes them more involved in it. However, bear in mind, if they are partners in the business, you do have joint and several liability. Now, this works both ways, so just be careful when you're looking at cheque signatories. Do you trust your children? Should they have sole signatory on the chequebook, or do you want to have more than one cheque signatory? But whatever you do, make sure you put a partnership agreement in place. It's absolutely vital to lay out the terms for the occupation of the property, governs the relationship of the business, and allows decisions to be made and agreements to be made at the start when everybody's getting on. Other options, if you don't perhaps fancy a farm business tenancy or a partnership, one of the further considerations would be a limited company. These don't tend to be quite so common. However, if there's perhaps a trading risk over the business or high tax rates are being paid, then we do consider a company. But these are secondary options generally. Another option perhaps would be a share or contract farming arrangement or a grass-let agreement. These are not as robust with HM Revenue and Customs when it comes to inheritance tax planning, so we do try to steer away from these if possible, but there are certain situations where these do actually work. What are the benefits? Well, you could have the children as the farmer if you wish. If you've got owners, so for example parents living in a valuable farmhouse, it can protect the farmhouse from some of those reliefs, but we do come across problems with the revenue when we have got development land or land with high amenity or hope value and particularly valuable farmhouses. So you do need to be careful when you're considering these as a possibility. So then we move on to the property and when you may or may not wish to consider transferring this down to the next generation. Now, the first option, and perhaps one that's more do consider, is to leave this on death. Why would you want to do that? Well, at the moment we have some quite valuable inheritance tax reliefs, namely business property relief and agricultural property relief, and this allows property to be transferred on death at full market value with no inheritance tax, as rules stand at the moment. This is provided the property is being used within the trading business, and it does mean that we don't have any tax considerations at the date of transfer if we're looking to transfer during lifetime. What's the problem with this? Well, we do have to consider that the business property relief and agricultural property relief that we currently have are under scrutiny. This may not remain forever, and we do have to consider that the rules could change. We also need to take into account that parents may need to go into care homes, care fees will be payable, and that could put some of the assets that they hold at risk. So they may look to transfer property before death, i.e. during lifetime, to remove some of the value from the estate. The other alternative is to transfer, as I've just mentioned, during the lifetime. Now, what are the pros and cons of this? Firstly, look at your children. Are they settled or not? What do you consider the state of their relationship? Are there other children that you need to consider? Is that going to cause family dispute if you transfer to one during lifetime and then perhaps leave non-farming children until later on? If you are in doubt, speak to your children, find out what they want. But primarily, make sure you look after yourself. Don't transfer all of your assets across to your children without taking into consideration your own needs. Okay, so why would you transfer the property across to your children despite some of the risks? Well, some of the benefits. Firstly, it gives your children motivation, allows them to feel much more of a part of the business, and it gives definitive succession, makes them see or allows them to see that the business will be coming to them or partially to them, and it may make them more keen to work in the business and to drive the business forward. Care fees we've already mentioned. We don't want too many assets in the estate if you think that you may well go into a care home at a later date, or perhaps this is something that you're worried about. And by transferring property during lifetime, it can move the property down to the next generation, which ultimately may be where you wish to have the property sitting. Another option that isn't perhaps often looked at is the marriage risk for the parents. We've spoken about the marriage risk for the children and whether or not you want to transfer property down at the moment. However, unfortunately, some parents' marriages don't last, and this may be a reason to move some of the property down to your children now. Then we need to consider the inheritance tax. If you have large estates with a high value of non-farm assets, perhaps development or amenity value, you may want to look to move some of the value out of your estate at this point and not wait until death. And then, again, we've already touched on this, but the rule change risks. At the moment, we do have the valuable inheritance tax relief. These may not last forever, and they are already coming under scrutiny. So one of the next considerations is how to provide for non-farming children. So if you want to leave the farm and the farmland, buildings, etc. across to the farming children, what do you want to do, or what are you going to do for children that aren't going to be working on the farm or perhaps have already moved away? You could consider cash gifts during the lifetime if you have the resources to be able to do so. If you're not quite so sure about gifting money at the moment, you could transfer money as a loan and then gradually write that off over time if you feel that their situation has become stronger and safer. If you've got non-farming assets, for example cottages, shares or investments, you could consider leaving those to the non-farming children. And again, that can either be on lifetime or on death, whichever suits your circumstances better. If you do consider gifting in lifetime, just be careful of capital gains tax if there's a gain on the property or investments that you're holding. If you don't have any cottages or shares or investments that you might want to leave to the children, you could look at life policies as a way of providing for those non-farming children. We then move on to the inheritance tax and will planning considerations. So if you're looking at your inheritance tax position, make sure that the relief is maximised. Inheritance tax at the moment is either inheritance tax relief, so agricultural property relief or business property relief. We either have rates of 100% or 50% depending on the structure of the business. Make sure that you have maximised that wherever possible. Don't be stuck with 50% relief if 100% relief would be available just with a few tweaks of your situation. Maybe look at gradually gifting some of your assets. Again, just removing some of the value of your estate over time so that on eventual death the inheritance tax burden that you're perhaps left with is reduced. Remember that for a married couple there are two nil rate bands of £325,000, so a total of £650,000 relief to cover those assets that do not qualify for agricultural or business property relief. If the total value of the estate is below £2 million, there is now the additional house relief where you're leaving a residence down to a direct descendant, so that would be children or grandchildren. Don't make the mistake of thinking that additional relief is available if you're leaving it to anybody other than a direct descendant. So again, just be careful. Use farm business tenancies where possible. This sometimes can devalue the whole of the estate on death, and it may suit your circumstances where other options perhaps aren't so suitable. And where possible, protect the working farmer status if you are looking at grass-let arrangements or share or contract farming. And then finally, we'll look at the wills and options available here. Primarily, what should you do here? Well, first of all, make sure you do actually draft a will. It's much easier and tidier to have it all set out in a will than leave an estate in an intestate position, which can be very messy and very costly. Make sure you keep your wills up to date. It's all very well having a will in place, but if it's 20 years out of date, it may not reflect your current wishes. Do consider inheritance tax when you're drafting a will. Sometimes little tweaks can actually save quite a lot of inheritance tax, so do take advice. And consider what will happen to your business if you die. There may be provisions that you want to make in that will just to govern how the business will continue after you're gone. And finally, consider whether or not you should make a lasting power of attorney. Not many people do this, or not as many as perhaps should. Very easy to put in place, very difficult for others to deal with if it's not put in place early enough. And I will now hand back to Andrew.
Thank you very much, Liz. That was a really informative run-through of a lot of issues there. Plenty, I'm sure, of food for thought for people, and do keep your questions coming in if you have them, any follow-ups from that. But now, before we get into those, we'll hand over to Clive for our second presentation. Thank you, Clive.
Thank you very much, and good evening, ladies and gentlemen. My name's Clive Beer, and I practice as a chartered surveyor and a chartered arbitrator and a trust and estates practitioner. And I've got an amazing job because I get to go across the United Kingdom, and it gives me a really privileged position to see what's going on in rural communities, and especially in relation to family succession. And I'm afraid I'm going to start my talk with some bad news. And that really is what I see. Because if we start looking Sorry, Andrew, can you, for some reason I can't move the slides. Could you move the slides for me, do you think?
Hello, Clive. Yes, that'll be no problem. We'll take care of that for you. That's better than you losing audio. We thought you'd done that for a minute.
No, sorry.
Yeah,
so
let us know when you want to change, all right?
Okay, thank you.
Perfect.
So if you can move the slide, and what can I see? And you go, and there's a stream of slides here. So if we start going, you can see the first slide, if you can just move on, and the second slide, the third slide, move on again, the fourth slide, and this is all cases that have appeared in the United Kingdom, and they're all court cases of families who thought they'd never be in litigation and then find themselves in that position. And this is such a complete disaster. So go on to the next slide, please. And the next slide again. And the seventh slide. And it goes on and on. And the eighth slide. And the next slide. And then the next slide. And then hopefully we get to the 10th slide, which is a graph, okay? And that deals with inheritance tax claims that have been posted into the High Court. And if you look at that slide, you look how many cases were being posted in 2004, and now look at how many cases are being posted in 2018. And that is a complete nightmare. So what's the state of family litigation in the United Kingdom? Well, I would say it's a disaster. It's just seen a huge proliferation of cases, and really it's never been as bad as it is today. And that really, next slide please, poses the question, so what is the solution? Because my job around the United Kingdom takes me to look at different situations, and I get involved in family litigation. I get involved in dealing with family disputes and finding a way to avoid litigation or to resolve litigation. And if we go to the next slide and we look at family wealth failure, then there's two issues there. There's either fiscal reasons for wealth failure or people. And if you look at fiscal, then there's taxation and investment performance, which can obviously bring a failure to a business, or people. And that could be disharmony, a failure in family conflict, or unpreparedness of those people who are going to inherit. Next slide. Now the next slide is really important, because this looks at wealth retention in families through generations. And if you look at that wealth that's generated in a first generation, look how it diminishes to the second generation and how it can diminish to the third generation. And that's across all different types of family businesses. And you might be saying, well, farming's different. But it's interesting to note that if you go back to the vast majority of those farming cases that we were looking at, how many of those cases actually were about rural property? And the reality is that rural businesses are much more likely to find themselves in litigation. And so we've really got to look at that and really ask ourselves the question, well, why is that the case? And so the next slide, where does it all go wrong? And the perception is, and there was a survey there that was taken at Harvard University looking at why families fail. And 63% of families thought it was due to investment risks in the economy and financial markets, so the fiscal reasons. But the reality was that 60% was due to a lack of communication and trust, and 25% due to unprepared heirs. And only 3% was due to failures in financial planning, taxes, and investments. And so that really poses a difficult question, because so much of our planning for succession is going to be around tax and trusts, when actually the vast majority should be preparing people to inherit wealth and inherit business for them to come into. And so a lot of my time is trying to adjust that balance and look about how we can prepare people for wealth. So the next slide, please. And what is effective family governance? And sometimes we can have very romantic ideas about what is family governance. But the next slide, this is where I want to major in terms of what I'm going to talk about today. And this is the solution, the family constitution. Now that's a very, very grand way of describing something that is an agreement that is written down in a family, and it could be a big family, a big farming family, a small farming family, it doesn't really matter. But what it does, it records what people understand in a family context that their position is, and what they can expect to do in a family, in a farming situation and a family business, and what they can expect to inherit and what they can expect to earn. And this is I can't think of anything else that I could do to help a family that would avoid them getting in disputes and going down this route. And so how do you go about creating a family constitution? Well, the first thing is to start a dialogue within a family context. And often it can be easier for an outside party to the business to almost act as a chairman to those discussions, or act as a go-between between different generations. So to ask succeeding the next generation coming through what their expectations are, but also to ask the same of parents. Well, what do they expect in terms of commitment? And what I'd like to do is to go through the different areas of discussion that might then find themselves into a family constitution. But before doing that, there's something I'd like to say is that most of the litigation cases that happen because people succeeding to wealth perceive that they were promised something. And sometimes, kind of parents might say, well, if you come back to a farming situation, one day you will inherit this. And then people rely upon those promises that were made to them, or those undertakings, or what was said to them. And the trouble is, that's not recorded. And when things aren't recorded, that's when confusion happens, and that's when litigation can happen. Because when people become disappointed later in life, and they've put their lives on hold to come back into a farming business, and they find that frustrated, then that can be hugely problematic. So let's go to the next slide, and let's consider the questions to consider when drafting a family constitution. Okay, well, the first thing that I would look at is, does the family actually have a long-term strategy for the business? Is that defined? Do the family members know where that business is going, and actually what's going to be required? And if a business doesn't have a strategy but is just reactive, well, how can you succeed to a business that has no strategy? It's a hugely dangerous way to plan for succession. The second thing that you might look at is that concerning values. What's the family about? How does it conduct itself? How does it kind of have relationships with people inside the family and outside of the family? How was the wealth created in the first place? What's its attitude to working, and so that actually that really does need defined, because what are people signing up to? And then thirdly, looking at ownership. How is the business going to be owned amongst family members? Is land going to be owned completely by the parents and are tenancies going to be granted, or is the equity in the business going to be passed down? And if so, when? And how is that going to be shared? And the next slide, please. We look at income. How are people going to be rewarded for the work that they do in the business? How are people going to be provided for? And what is realistic expectations in terms of earning potential? And in terms then of looking at employment of a family, how should family members be employed? Should they leave school at 16 and come straight back to the farm, or should they actually go to agricultural college, or should they go to agricultural college and then work away for 10 years before coming back to a family farm? All of those things need to be considered to see if it will work. And then professionals. How are you going to deal with professionals that are going to help to advise the family? That could be accountants or solicitors or surveyors or agronomists or farm management consultants. But what's the policy for employing third parties to help advise the family? Next slide, please. And then the family might consider actually having a board of how that family business is going to be run, and who's going to sit on that board. And you might actually bring in people outside of the family to run that business. And certainly there's farming families where I act as a chairman to family boards to help them with the decision-making process. And then we come to the governance. How is the family business going to be run? Who's going to have control? And then in terms of key decisions, who makes those key decisions? How do those key decisions come to? Who makes who has the power in the decision-making process? And how does that come about? And then the next slide, please. And then we come to the next generation. And one of the thorny issues that often I find in terms of dealing with family succession is that often families have got real concerns about the threat of divorce and what that can mean. And so what I would always say to next generation or aspirational next generational people is this: don't wait for people like me or your family to raise the issue of prenuptial and postnuptial agreements, but raise that yourself. Because actually, taking that responsibility for entering into prenuptial agreements and postnuptial agreements means it makes the whole process of gifting land and property to be so much easier. And so I would strongly say and strongly urge you to go down the route of taking that initiative, and don't be embarrassed about it. Make it so it's just simple to happen and simple to operate. And then we look at information. How is information going to be shared within a family? And how's that going to be dealt with? And who gets information? Who gets financial information? And then disputes. In families, all families can have disputes. And the important thing is to never ever let disputes get out of hand. And if there's a problem, deal with them early. And what I would always say in a family constitution, always have a provision that family members will never litigate until they have formally mediated a case. Now, if you've been through that process of creating a family constitution, can you imagine how wonderful that is in terms of stopping people litigating in the future. Because what you've done, you've had all the difficult conversations. People know where they stand. They haven't got great expectations of life. They've got accurate expectations. And that's what matters. That's what makes it much easier. And I would always say to people, please, please find a way to resolve your differences. Now, the next slide. The price of greatness is responsibility, so says Winston Churchill. And here, this is about choosing often the principal successor. And in situations you can find that in terms of a single person coming into a business, often that can be the way. And if I can ask Andrew just to keep flicking on, going to the different points here on this slide, is character. Does the person who's going to succeed have the right character for the business? The next point, education. Do they have the appropriate education to enter into that business? The next point, passion. Do you know, I've never met somebody who is passionate about their business to the extent that they can't be successful. People who are passionate tend to be successful. The next point, commitment. Do they have that commitment, that drive? The next point, skill sets. Do they have what it takes to be successful within that business? Can they bring complementary skills? Age. What I always think is age is not really the issue. It should be always about ability. And then in some estate clients, then there's issues relating to people having titles. And is that the way that people should succeed? And I would suggest it never should be. It should always be based upon the ability of the individual. And then the next slide, please, which is appropriate lifestyle of successors. What is it? Okay. Well, there's a slide there, something that perhaps doesn't suggest lifestyle choices that really are consistent with good family business. That was a situation of a recently ennobled lord who got caught in a sting. But if you've got aspirations to inherit, are your lifestyle choices consistent with having wealth handed down to you? And so I would say that there should be some soul searching about actually some of the decisions that people make. And are you fit for purpose? Are you fit to inherit? And then the next slide. What is a will? Well, a will should never be about surprises. A will should merely, and it should only ever merely be the confirmation of what the family understand will happen in the event of a death. And if it's anything else, that can be a huge precursor to causing problems and actually being the catalyst for litigation. Because there's nothing like a will to break bad news to people, to make them feel very angry and cheated. And on many of these cases, the cases have arisen because promises that were made in the lifetime haven't been honoured. And so a will should only be a confirmation. And then the next slide, and the final slide, is the consequences of getting it right. Well, ladies and gentlemen, can I just run you through all of those cases there that have been heard and judgments made by the High Court just in 2019. And can I suggest respectfully that if you get it right, you will not find yourself on that list. So, ladies and gentlemen, thank you. You've been very patient, and I'm grateful for your time today. Thank you.
Well, that was perfectly good time. Thank you very much to both Clive and Liz beforehand. Two very insightful presentations, and I'm sure that's given us a lot to think about. We've had some questions coming in, and I'm going to bring in Ian to field the first one. A very interesting question from David. We've heard a lot this evening about how to hand the business over to a family member, but David, can you share with us any insight on the difference between that and handing it over to a paid employee or someone outside the business? Is there anything further to think about there?
A lot of what Liz has covered in her talk would apply to an employee the same as handing it down to a family member, but then it's not clear from David's email how he intends to hand it down to the employee, whether he wants to sell it to him or whether he wants to gift it to him. So those are things that will need to be taken into account, and if he wants to gift it to him, then they'd need to watch to look at whether it was done for personal reasons or whether it was being passed to him due to his employment, in which case there could be some nasty tax implications of that. And then I guess, I don't know if there are any other family members involved, but he'd certainly need to make sure that there wasn't any likely disputes that were going to arise as a result of passing it down to his employee. But by and large, most of what Liz has covered in the slides would cover the situation for handing it down to an employee as well.
And in the event that there are family members, they have no recourse providing that's been structured appropriately. That's fair to say then.
Well, that's right. They'll need to speak to a good lawyer, I would say, and as long as they structure it correctly, then there probably is no comeback from the family members. But then I don't know if any of them have been involved in the business for any length of time, and they might feel they've got a claim on the family farm. I don't know.
I just want to bring you to a fresh point now, Ian. I will try and avoid using the B word. I'm sure everyone's sick of it, but I'm sure everyone will be interested in hearing from you as to whether you've seen any uptick in interest around succession over the last 2 to 3 years due to the proposed phasing out of direct subsidies and general sort of market uncertainty.
We haven't noticed any particular rush to bring in the next generation on any of our clients any more than usual, really. I think a lot of farmers are just waiting to see what happens with whatever new system comes in terms of subsidies and where they're going to go with it. But certainly, we've had no rush of clients suddenly wanting to bring new family members in as partners any more than usual, really. It doesn't seem to have affected their way of thinking on that area.
Yes, very much sort of hunker down and wait and see at this stage. But
yeah, that's the general approach.
For those that sort of are freshly contemplating it, then if there sort of are people in that situation at the moment, is there any particular additional advice you would want to relay to them, given that sort of the outlook is more uncertain than normal, or is this about such long-term planning that it sort of overrides those issues?
By and large, we tell them, you don't want to let the tax, be the tail that wags the dog, so to speak. So you need to make sure it's the right thing to do for your circumstances and your family, and then maybe worry about the tax side of it. And obviously also people where they are umming and ahhing about whether they should bring somebody in as a partner or not, then we also make them fully aware of the recent suggestions from the Office for Tax Simplification and some of the possible things that could change there. So if they are considering bringing in a new partner and passing on some of the farm, that they might want to think of doing it now before there are any possible changes. But then on the other side of the coin, with everything going on with Brexit, then I'm not sure that the government will do anything drastic in terms of changing any of the reliefs that are available at the moment.
Yes, it's interesting. Those reports that we've seen in the last few months, they are very much just proposals at this stage. Is it just a watching brief for most businesses then? Is it fair to say that, or is it fair to say that as the circumstances are as perhaps good as they can be for most businesses, they should be thinking about acting perhaps a little bit swifter than they had been.
Yeah, I mean, the rules are probably as good as they're ever going to get when it comes to the IHT release at the moment. So if it is something that you're going to be thinking of doing, it might be better to act now. But like we say, you can only really make any decisions based on the current rules because there's no way of knowing for sure whether any of these suggestions that have been made will actually become reality, to be honest. I mean, was it 2011 we had the Merleys report, which suggested various things with IHT, but in the end, the government didn't act on any of them. So at the moment, it's difficult to say whether they'll do any of the thing here or not. And one of the things that, if they did, that would most affect some of our clients would be the possible increase in the test for whether overall it was a trading business where clients have got a lot of rental properties on their farm, and at the moment they'd probably qualify for 100% business property relief based on the Balfour and Farmer cases, but if the revenue make the test for that more stringent, then they're more likely to fall on the side of investment asset than a farming asset, which would mean they could be affected quite drastically by these proposals.
Yes, you mentioned rental properties, but also it would be a number of different diversified farming businesses, wouldn't it, where they've seen a diversification grow beyond perhaps the general farming business. Is that fair to say?
Yeah, that would be a fair comment. You know, if they've got like PV units and that kind of thing, so the amount of income that's coming in on the farm is more investment orientated than farm orientated, then they could well be at risk under these suggestions.
And one proposal that we've heard this year that our listeners may be interested in is the removal of capital gains protection upon death, which could bring forward some succession planning as well, couldn't it? That would be quite significant for farming, wouldn't it?
It would be very significant because for a lot of clients, they decide that they'll pass the assets on death with all the reliefs, IHT reliefs that come with it, and then they'll get the uplift in base costs for capital gains tax purposes for the children or grandchildren that they're passing on to. Whereas if they're not going to get that anymore, then they might well consider passing on in lifetime instead.
Would you go as far as saying that perhaps for certainly the younger generation that would be quite a benefit if that was introduced?
Well, it depends on their attitude, really. I mean, if they want to carry on the farming and they want to get their hands on the farm, then that could be a benefit to them. But obviously you get one or two cases where the children aren't interested in carrying on the farm, so I think they'd rather get it when something happens to the parents, and so they can sell it on with a higher base cost for CGT purposes.
Yes, indeed. And speaking of land values, something that our readers certainly are very interested in from our website viewing statistics, are any of the proposed changes, do you think, and I'm really asking you to stick your neck out here, I expect, do you think they would have any impact on land values?
That's probably more one for Clive than me, but I think that prices would fall if they've not got the subsidies that come with them anymore, I would imagine.
I think it's
a handle on that.
I think it's inevitable that if there are major tax changes that was actually diminishing the ability to claim inheritance tax relief, it must have an effect on land values, and that would be it's a clear and present danger.
We'll just come back to another question from the audience now, and this one for Liz. This one came in during your presentation, Liz. We have got a question from Alan, and he says, I'm going into partnership with my father. He wants to keep all assets, including machinery, land, and buildings. And could you just explain what the tax implications are there?
Yeah, I mean, it will depend sort of slightly how they want to transfer. Generally, if you go into partnership or if you're coming into business with your parents, ordinarily the machinery generally and the trading stock would remain within the partnership. Land and buildings sometimes stay outside, certainly in the first instance. So it would be quite unusual to actually go into partnership and keep the machinery outside of the business. That would actually then need to be transferred. You'd need to look at the value that you were transferring the machinery out of that existing business. It's slightly difficult to answer that completely. I'm not sure if his father is operating as a sole trader at the moment, or whether there are other parties and whether there's an existing partnership. So depending on whether we've got an existing partnership and we're moving machinery out of that, it will depend slightly on the tax implications. But certainly going forward, you would need to look at how you're going to be buying and selling machinery in the future. So if the father's going to keep that in his own name, there wouldn't be any relief in the partnership for the purchase of that equipment. So then are you going to be looking at having the father hiring that into that business? The father then would effectively have a sole trade alongside the farming business of hiring equipment potentially. So there are sort of other tax implications slightly wider than just the partnership situation. In terms of the land and buildings, you would need to look at the reliefs available for inheritance tax at a later date. So the business property relief and the agricultural property relief. If those are held outside of the business, there is a risk at a later date that the rate would drop from 100% down to 50%. So that's something that he may need to consider or want to consider carefully. So there are a number of implications there, and it's not entirely clear from the question what the situation is, but certainly more advice would be needed.
Well, sounds like there's a number of different issues there for Alan to consider. I hope that's of some additional help to him. We've got another question from the audience. This time I will throw this one over to Ian. Farmer age 76 owns a 150-acre farm. He has a son who has had some ill health but is now mostly recovered, and he would like to make him a partner. But due to the age of the senior partner, his solicitor is advising him to currently do nothing. And now we don't know the whole circumstances there, but just on the tax issues, is bringing someone into the business versus not at that stage. Ian, what would be your advice there?
We certainly wouldn't say there would be an issue with bringing the son in, just because David is currently 76, that if anything, if the son wants to be involved in the business and is capable of being involved in the business, then we'd encourage it, really, to bring him in and maybe pass on a share of the farm, maximise reliefs going forward, bring him in as a partner, make the farm a partnership asset. Without knowing all the circumstances, David's circumstances, we certainly wouldn't say that 76 was too old to bring the son into partnership. In fact, we've had cases where people in their 80s, even 90 in the old case, where they brought the next generation in as partners as a way of passing the farm on and securing their position. So we wouldn't say that 76 was too old to bring in the son as a partner.
Interesting. Well, hopefully, David, that will go some way towards addressing your concerns, and hopefully that gets resolved for you. I'm just going to come back to Clive now. I'm sure some of our listeners will be as interested as me, having seen that graph that you put up, Clive, towards the start of your presentation, where the number of court cases between 2004 and now have increased dramatically. Is there any particular reason why there has been such a sharp increase in that sort of 15-year period, Clive? And is there anything else beyond what you said tonight that farm businesses can learn from that increase?
So I think there's a general awareness that that's crept in, and I suppose there's of litigation as being a possible solution, and that perhaps if you went back 20 or 30 years ago, people were quite reluctant, but also the reality that people are being better advised about the rights that they may or may not have. And so if you what's happening now is young people who perhaps find themselves, and they think they're being treated unfairly, they might find themselves going to see a solicitor who suggests, well, actually, if you're going to want to challenge this, then the only way that you can do it is through the litigation process, to see if actually that as a backdrop something can be done. And so I think lawyers now are very quick to advise their clients that this is a potential route for them. And I think in an age where people are just better informed and more litigious, and I think that's one of the sad things, is that people in Britain today are generally more litigious, and I think the genie is now out of the bottle. People are much more likely to want to litigate, and of course, with all of these cases being spoken about in the press, just the general awareness and consciousness is now there that it wasn't there 20 years ago. So I think that the only way that you're going to avoid that is by making sure that discussions that happen are recorded, and that people do not go forward making rash promises that they don't intend to keep, or relying on something that was said to them. Because actually, if that's what you're investing in, then actually later in life you can find yourself with a difficulty. And of course there's a situation where you can we can have a discussion. I can say one thing and I know what I meant, and you can hear another. And I think that's what often happens in these cases, that people are wanting to hear what they want to hear, and sometimes there's a lot of misunderstanding and confusion and perhaps wishful thinking, and so all those blend to get to where we are. So I think the simple answer is, when you have a discussion, make a record and make that clear that everybody is party to that record.
Well, I think some of the politicians in Westminster might be benefiting from that advice as well. I'm sure they're hearing what they want to hear quite a lot of the time in the House of Commons at the moment. We've got time just for a couple of final quick-fire questions. I'm going to come back to you, Liz, with a question from Helen. We know that there are a number of different ways a business can be structured, but she's asking, what would you say are some of the most important issues to cover in a partnership agreement where a business is operating as a partnership?
I think, to be honest, there's a vast number of issues that you would want to include in a partnership agreement, but primarily you would want to look at the control of the business, who has the sort of final say when you're making decisions. If there's any property held in the partnership, what ratio is that owned in? How is that held? Is it partnership property or is it actually held outside? Profit sharing ratio, I think you would need to perhaps include some flexibility in that if you wanted to, by way of prior salaries perhaps, or if you do want to have the profit shared in a very rigid way, make sure that that's covered. In terms of financial situations, obviously partnerships bring with it joint and several liability. So I think you would want to include perhaps some of the sort of responsibilities that you would expect your fellow partners to adhere to, just to give you some element of sort of comeback or protection if possible. And I think if a disputes do ever arise at some stage, I think you want some sort of format to follow as to how those disputes may be resolved. So I think there's, as I say, the list does go on, but I think perhaps those are some of the most important ones.
That's really helpful. Thank you, Liz. And I'm sure given Helen some food for thought there, and I'll remind her and everyone that you can listen back to this webinar if you didn't manage to write down everything in your notebook then, Helen. We'll go to Ian for the last word. We've got a question from Mark. Now, Mark's saying, I'm in partnership with my father and have been for some 30 years, working on the farm for 43. There is a partnership agreement signed by myself, but not by my father. The accounts are drawn up annually on the basis that we are both partners, but are we? he will also not disclose any contents of his will. What advice would you offer Mark there, Ian?
I would say if the accounts have been prepared for 30 years and signed off by father and son, and they've been submitting partnership tax returns, and the VAT registration is in the partnership name, and the bank accounts in the partnership name, then I would say Mark has got a very strong case that he is indeed a partner, despite the fact that father hasn't signed the partnership agreement. I mean, you might want to see a solicitor, despite everything that Clive said, but I would say there's a very strong argument there that he is classed as a partner.
Very interesting. Well, I'm sure Mark will want to take some professional advice on that, as you say. Well, thank you very much to all of our speakers this evening, to Clive, Ian and Liz. That's been really helpful, and I hope that that's been of as much use to our listeners as it has been to me. I'm going to close with a very quick reminder that I heard at a talk recently of why succession planning is important, and that is in order to deal with death, disability, disaster, divorce, disagreement, and debt, which are the top 6 things which can strike at the heart of even the most successful businesses. So I shall leave you with that cheery thought. So from myself and the other speakers, thank you very much for joining us this evening, and do come back for the later webinars that we'll be having in this series in partnership with Baldwins. Thank you very much, and have a good evening.